Testing 1, 2, 3. All right, for the ones that are joining in right now, I want to let you know that this webinar is being recorded. It will be put on my website, hopefully within a week or less, as soon as my IT guy gets it going. And at this point, Judd, I've got 6:30, so I'm just going to turn it over to you.
Fantastic. Well, it looks like we've already got a lot of people showing up. I'm extremely excited about this particular webinar. Craig and I have decided to team up on a very aggressive schedule of at least 6 webinars that we're doing together. This is, I think, the 3rd one, and I think this is very applicable to those, as Craig said, that want to save taxes. So tonight we're going to talk about some incredible vehicles that can really help you out and probably make the IRS not pissed off, but we'll take money out of their hands whenever we can legally. So I do have to kind of start with my again, Craig Lancaster, my CPA. Absolutely awesome. I got to say, lucky to find this guy. He's amazing. I probably will ask him a couple of questions along the way. I do need to put my disclosures up on the screen. This presentation is for educational purposes only and is not a recommendation to buy or sell. More importantly, we're going to talk about a lot of tax implications tonight, and I am not a CPA. I cannot give tax or legal advice for that matter. So I'm sure most of you probably have a great CPA. If not, Craig is always there in the wings to answer questions for us. He doesn't charge by the minute or by the hour or by the paperclip. So he is there if we do need to ask questions, because these are going to be very interesting in the alternative space. I always like to start off with a good quote. My grandmother actually had this quote, I think, before Warren Buffett did. But, you know, Warren says, if you don't find a way to make money while you sleep, you're going to work until you die. My grandmother used to say, Judd, I love to make money while I sleep. And she talked about the Jefferson, which was Jefferson Pilot, now part of Lincoln Financial. If y'all watched the Monday Night Football game, that was played at Lincoln Financial Field. So I think this is awesome. And a couple of ideas that we have tonight definitely will make you money while you sleep. Our first presenter is going to be Alan Wagner, Associate Regional Representative over at Eaton Vance Distributors. And I'll start off by saying that my father took some of that Jefferson Pilot and started what is called a charitable remainder trust. And there's a lot entailed in a charitable remainder trust. And so this is kind of a, I would say, maybe a substitute, really. Craig, could you just real quick, from a tax perspective, outline what a CRT is for our attendees?
Well, a charitable remainder trust, there's different ones. As y'all might have heard of CRATs and CRUTs and so forth. What you need to know is a charitable remainder trust is very difficult, not difficult to set up. It's very expensive, number one, Judd. I mean, usually you go through an attorney and they charge quite a bit of money. I'm sure your father is well aware of that. I mean, I've had a few clients ask about it. To me, if they're not willing to have $1 million to put in it, to me, it's just not worth the effort. I'm very excited about what Alan's going to be speaking on, because he's going to take a lot of this red tape out for my clients, and they're going to be able to write off up to 60%. There is some calculations that goes on with the IRS, but the good news is Eaton Vance and the U.S. Legacy Trust will actually do the calculations for them. So I'm very excited about this, because I'll be honest, Alan, this is kind of new to me. So I'm hoping Alan's going to teach me something too, because it sounds like it's a lot easier to do than a CRAT or a CRUT, is what I'm.
Absolutely. And by the way, on a CRUD or a CRAT or CRT, you have to have a trustee. My father thought that I would be the right person to put into that. And we do this little dance every year because we matched it up with an income replacement. And so he gave away $1 million, got a wonderful tax benefit from it. My father and stepmother get a 5% income every single year. When my father passed, now my stepmother does. They gift that back to pay a big insurance premium because my dad didn't want us to lose that money. But this is a fantastic way. I'm going to go ahead and flip the screen over to Alan Wagner. Y'all probably read some of his bio here, but Alan, take it away, sir.
Thank you, Judd. I very much appreciate it. Good news and bad news on that slide. The good news is, and this is on me, as I sent Judd a bit of a dated bio. I've graduated to being a vice president and a regional representative, so that's the good news. The bad news is, if you saw that picture, a lot of that came with more grays in the beard. So there's good and bad news, right?
It does happen, my friend.
It does happen, whether we want it to or not. So the first thing I'm going to do is share my screen and make sure that you guys see this visible here.
Yep, we got it.
All right, perfect. So before we get started, I think it's a little interesting to give you a little background on myself. And one of the main things I'd like to highlight here is what it is that I do. So as mentioned by Judd, I'm a regional representative representing Eaton Vance. We're a $1.5 trillion asset manager. So that's a lot of money, so we have a lot of expertise. And the U.S. Charitable Gift Trust is a subsidiary of ours that highlights and has been working for many years really on these charitable donations. And my job specifically, the best way to put it is to be a consultant to financial advisors like Judd. So essentially, I'm traveling around all of North Carolina, working with multiple different financial advisors and helping them with their practices. The reason I think that's important is I want you to realize how unique of a situation you have, where you have Judd and Craig that are willing to set up Zooms and webinars and different information to help teach you about new ideas and different ways to help you, whether it be save on taxes, help grow your assets, and helping you retire. It is something unique that I don't see every day. So I just want to make sure to highlight how important that is and how great of a team that you have that you're working with. So to get started on what I really want to highlight here is we're going to be talking about, as mentioned, legacy income trust, or LIT as we call it for short. LIT is a newer product, but it's built on the foundation of an older product called a pooled income fund. So what I'm going to do today is I'm going to talk to you a little bit about the history of charitable giving. I'm going to talk about what differentiates a legacy income trust in our offering, and then I'm going to wrap up with a pretty great example to help highlight to you from a number standpoint where this could really be beneficial. So right here,
Alan, yes, real quick, I don't know, your audio went different a little bit. Not sure if Craig noticed that too, but it almost sounded like maybe your microphone was a little covered up there.
Yeah, it definitely changed.
All right, how about now? Can you hear me? Hear me now?
Yes.
Better.
All right, perfect. One other thing you might not know, and I didn't want to go this deep into my history, is I grew up in New England, so I talk fast. So maybe it's picking up a little bit quicker, so I'll make sure to slow down for you too. And please let me know, Judd, if you have any questions or if anything else came up. So once again, we're going to highlight a little bit of the history of the product and where it came from. We're going to talk about the intricacies and how it works, and we're going to finish up with an example. So when you think about charitable giving, the biggest piece people tend to talk about is I'm giving away money to a charity, which is absolutely the truth. And these are irrevocable gifts, meaning you don't have an ability to a year or two say, oh, I want that money back. These are irrevocable, so make sure you understand that. A lot of the charitable products people tend to hear are things like charitable remainder trust or a donor advised fund. We'll talk a little bit about the history of those later and what they are. But right now, what we're going to focus on is a pooled income fund. What's interesting and unique about a pooled income fund is it allows you to distribute income. This is why it's a direct comparison to something like a charitable remainder trust, which Craig did a great job of highlighting. But at its basic point, you are giving money to a charity after you take your income, and whatever's left over is what's given to the charity. And there's a calculation done there as to how much of a charitable benefit you're going to get up front. With us at U.S. Charitable Gift Trust, where we tend to highlight ourselves is we want to innovate. And one of the innovations we had was something called a pooled income fund. What this allowed us to do was to distribute income in an investment vehicle, but like mentioned previously, is to take away some of that red tape. Essentially allow us to have a turnkey solution where we don't have to tap into a lawyer and we don't have to have a tremendous amount of expenses tied to setting up a product. The Legacy Income Trust is a new iteration of that pooled income fund. And the difference being, a lot of time pooled income funds are mainly invested in fixed income or a small blend of fixed income and stocks. The Legacy Income Trust allows us to take the benefit of dividend capture strategies as well as equity strategies to hopefully help highlight a higher return profile, which is going to be given, excuse me, sorry, this light went up in the office. Sorry about that, which is going to be given to the remainder charity as well as given a higher income percentage for you and yourself, as you can see within the screen. All right.
And again, Alan, it's kind of again fading in and out a little bit. I mean, I'm hearing you, but I gotta listen pretty closely.
Yeah, I'm not sure why. Nothing's really changed on the audio on my side.
Okay. It's better when you get a little closer. So
all right, perfect. You'll just have to see more of my face in the middle of the screen. So here with the pooled income fund, here I've highlighted a little bit of the history in the U.S. Charitable Gift Trust. We talked about this a little bit, but here is the actual component of how it works. So essentially you have a donor here in this area, and what the donor does is they contribute either cash or an appreciated security. Think of an ETF, a mutual fund, you know, any type of appreciated stock in those areas. And essentially when you contribute that into the Legacy Income Trust, you qualify for a partial income tax deduction. And we'll talk a little bit about what that income tax deduction is and how that percentage is calculated later. And then for those income beneficiaries, that you decide on, one of the major differences versus a CRT is that you can name up to 10 income beneficiaries. One of the reasons why I think this is incredibly important is it's not only a charitable product, but it's also an ability that you can control income for someone within your family. For example, let's say you have an appreciated security, and at your time of passing, you maybe have a relative or a son or daughter that you want to leave that to, but you're not comfortable with them getting a $500,000 or $1 million portfolio. You think they might spend it. What if you had the ability to take tax benefit while you were alive and then provide them lifetime income instead of just one lump sum? That's something that's malleable here that allows us to be a little different than those regular gifting strategies. And then obviously at the time of the passing of the last income beneficiary, that's when a charity of your choosing, a 501c3 or a donor advised fund, is able to then receive the benefit which they can then receive. And that's of your choosing. As long as it's listed as a 501c3 or a donor advised fund that you have set up, that it is a charity that's going to be able to receive those incomes at the time of the passing of the last income beneficiary.
I have a question, Alan. Does it have to be a 501c3? Because my father left money to Davidson College, for instance, in the CRT, and I don't think that's a 501. They probably have a foundation, and maybe that is directed there, but I'm just curious about that.
Yeah, so it does have to be a listed 501c3 and or donor advised fund. The reason being is in order to get, and I can't talk specifically to your father's charitable remainder trust, but in order for the tax calculation on the upfront to be calculated, it has to be given to a 501c3. And more than likely, Judd, candidly, it probably went to a foundation or something that they have set up as a 501c3.
Yeah, he did some to the Gee Family Foundation as well, which we give about 200,000 away to Habitat and other charities each year.
And Alan, I just want to interject one thing too, because I have a lot of my clients here. What I like about this is not so much my clients giving cash. I like the appreciated stock or securities, because they can escape those capital gains tax. I think this is really built for someone that, they might have bought Coca-Cola, Disney, Duke Energy stock 30 years ago. And I just wanted to make sure, I mean, they can do cash, But I think the bigger play here is the appreciated security. So I just wanted to make sure my clients understood that.
It makes a lot of sense too, Craig, because we contributed Jefferson Pilot, and I got left with a wonderful legacy, and a lot of you have heard this story, 20,000 shares of Jefferson Pilot. And I used to feel pretty good when I looked on my brokerage account every day. But when it went from $65 to $2 a share, I was not too happy. You can do the math on that pretty quick. Luckily, we'd already done the CRT, which allowed us to sell that stock, which was about $1 basis, and we diversified it into a much better portfolio. It didn't mean we didn't lose money in 2008, but we lost a lot less than 95%.
And you guys are both. It shows how smart and how great of a team you are, because at the end, that's the exact example we're going to talk about is appreciated security. So you're 100% right. So what are some of the features and benefits? We talked about a lot of these here, but one of them I really want to highlight. I keep saying income, but what does that mean, right? So just starting at the top, obviously we just touched on this, no recognition of capital gains if you contribute an appreciated security. You're going to receive an income deduction based on a charitable remainder. We'll talk about that, and there's going to be some examples at the end, but there is a link to the calculator here. And that's a perfect call to action for you to reach out to Craig and Judd to see what that percentage would be for you based on your age and time frame. What a great way to find out that information. And then we've talked about income here a few times. So here, based on, these are 6/3/23 numbers, the distribution rate, which is healthy, it's somewhere between 6.25 to 7.16%. This is based on the contributing amount. The more you contribute, the more income you get. But I want to give you a little updated number. This is as of October 23rd. So the floor distribution is 6.63, where the max you can get is 7.59. So you've seen an increase, approximately 40 basis points of that income stream. And what's great about this income as well, and Craig can tell you how great this is, it's qualified dividend income. So it's QDI, that's what we call it, instead of ordinary income. And just to give you a basis of how big of a difference that is, if you are in the top tax bracket, you're paying 23.8% in QDI. If you're in the top income bracket, you're at 40.8%. So there's a huge, huge difference there. Call it about 18 percentage points difference. We've already talked a little bit about what the trust invests in and some of the different pieces here. So that's the fourth piece. And obviously, we already talked about that remainder. So those are the main features that are built within this legacy income trust. Who's this for? Who would reach out to Craig? Who should talk to Judd? Well, first off, I think if you're on this call, that's a pretty good call to action to say, give Judd and Craig a call. But the people this really highlights for, if you have low basis stock, if you're looking for an income, maybe Craig touched that earlier, right? Don't pay capital gains. Take that out of the IRS's pocket and allow it to turn into a tax deduction and an income stream for you. If you're looking for that income in retirement, what a great benefit to do, and then to leave some legacy left over to a 501c3 of your choosing. Obviously, it's a turnkey alternative to a charitable remainder trust. We've talked about this. And also, I mentioned earlier, right, what if you're able to control income and proceeds for somebody within your family while at the same time taking a tax deduction while you're alive? All major benefits of this product to help you control your income, leave something to a charity behind, and obviously pay less to Uncle Sam, which is the theme here for our webinar. Here's some of the major differences, and I won't dive too much into this. I know this is a bit of a busy slide. Donor advised funds became very popular after the Tax Cut and Jobs Act. A big reason for that was we saw a doubling of the standard deduction. The idea is if you're a family, your standard deduction went from $12,000 at the time to approximately $24,000. That actually hurt charities because essentially a lot of people went from itemizing to just taking the standard deduction. So one of the major solutions was a donor advised fund. Essentially that allows you to build your own legacy and do something that we call bundling. So if you were saying, hey, I'm going to contribute $5,000 a year to this charity for the next 5 years, instead of doing it systematically that way, you can bundle them all in a donor advised fund, take a tax benefit within that year, and then also have that appreciate within the market. Obviously, there's no income stream, but it's a different vehicle in charitable giving. All the way on the right is a charitable remainder trust. We've talked about this. This is the ability, as Craig talked about earlier, it has some headaches operationally. It's a little bit more intensive, but it's the same idea of creating an income stream for you and leaving the remainder behind. A legacy income trust is not a perfect middle ground between them, but it takes a few of the best benefits of a donor advised fund and a general remainder trust and puts them in a bit of a different product tier set. So the advantage of a trust versus a traditional pooled income fund. We've talked about this before, opportunity to realize a higher total return, higher charitable tax deduction, higher number of permissible income beneficiaries, as we touched about. You can name up to 10 income beneficiaries, and there's different giving options that we have that are available for you here as well. So compared to other planned giving vehicles, we touched on this a little bit, but the part that I want to highlight here that's important is typically lower cost to establish and maintain. So we talked about charitable remainder trust and labor intensive, but also to maintain them a lot of times is also tax and labor intensive as well. So with that and the greater participation, I apologize, there's an issue within my office that continues to shut these off, so I apologize about that. The last piece I'm going to touch on before going into the example is the actual income tax percentage. So on the left, you're going to have the age of the income beneficiary. So if you are 50 years old, you get a tax deduction of 52.17%. If you were to do it within a CRUT, you get 15.22. And if you were to do it within a charitable gift annuity, you do it at 33%. For those of you looking at the slide, you see there's a bunch of dashes there. What does that dash mean? That means that based on an income stream that generally provides for a CRUT or a CRAT, you are too young to even set up these vehicles. That's one of the major benefits here, is you have the ability to write this on younger people, and at the same time, their income doesn't change. What changes is their tax deduction. We've actually written this on a 1-year-old, if you could believe it or not. So this is something that's malleable, that's able to be built in multiple different areas and to fit what it is that you're looking to establish with the partnership of Craig and Judd. And we can do this specifically for you and your family members. So as I mentioned earlier, we have an online calculator that Craig and Judd have access to. I will send that over to them. And it's a great call to action to say, hey, I really was interested in that conversation we had around the legacy income trust. What would my tax deduction be for appreciated security? And I can highlight that here for you. This piece, we talked about these a few different times, but this is the investment approach, and this is really what's different. So the reason we're able to take such high level of income is we do what we call a dividend capture strategy. I won't dive too far into the weeds there, but one of the bigger differences is that we're willing to invest in equities, and we have a 20-year track record here. So it's not something new, it's not a new hot dot. It's something we've been doing for a long time period. This helps us maximize returns so that the remaining charity will be able to get a higher dollar amount at the time of the passing of the last income beneficiary. It allows us to pass more income on to you and allows us to also have a better return stream over the lifetime of that. This is just a breakdown of how the portfolio generally is constructed. 40% of it is benchmarked to the S&P 5, and 60% of that is tied into that dividend capture strategy we mentioned. And here we go from a fee structure standpoint. So as mentioned earlier, I already talked to you about the updated distribution rates. This is a conversation, again, that I tell you to push to Judd and Fred. This is just to show the options that we have, and you see income goes up and fees go down the more you contribute. But the most important part of this slide is to let you know to talk to Judd, right? This is the conversation to say, what percentage of my assets do I think feel comfortable here, and where do I really help to contribute from an income stream and tax portion standpoint? This is the highlight for them in a very big way. And the last piece is we're going to talk about that example I mentioned. So we're going to use $1 million because it's nice round numbers. The person who owned this, or the beneficiaries who are both 60, did a great job. They were able to hit what we call in our business a 5-bagger, right? They 5 times their money. They were able, let's just call it Apple stock at 200,000. They were able to then contribute that appreciated security at $1 million. Don't worry about their combined lifetime expectancy. That's more for our calculation. But at that standpoint, they get 7.16% income. And as we mentioned earlier, right now, that would be 7.59% from that standpoint. What's really important too, and I didn't mention this earlier, is we can't guarantee this, but we also hope to raise income based on inflation. So that number isn't locked up. As we know, inflation has grown, It's been a hot topic we've all talked about. So you've already seen that income grow just 40 basis points since that June number. The other piece that you want to mention here, right, we're assuming that they're in the top tax bracket, so they're paying 23.8% from qualified dividend income. We're having tax savings that are reinvested for growth at 6%. And we're doing on the bottom, based on age 60 years old of 2 beneficiaries, of $1 million contribution, the estimated income tax deduction is approximately $543,000. This is important because it's an actual tax savings of $221,000. And we're going to break this down a little bit here. We're going to see first, what are their other options? So if they took that $1 million, they paid capital gains, and then they want to invest it in a bond portfolio, hypothetically, right? Their retirement age, they no longer want to take equity risk. They want to then wind down into their retirement. So in that situation, they would contribute $1 million, or excuse me, they would contribute $1 million into the legacy income trust. Based on the older percentage, they get $71,600, or now would be $75,900 of income. And after taxes, approximately that'd be $54,000. The other option is to sell that $1 million, pay capital gains, and then invest it in a 5% bond portfolio. What would happen? Well, they'd have to pay capital gains of approximately $190,000. That 5% bond portfolio, or CD, as we see CD rates moving that way, you turn that into $40,000 of income approximately. And after taxes on that income, you'd approximately get $23,000. So by contributing into a legacy income trust, you're now almost doubling, or excuse me, over doubling what your income stream is going to be. But that's not the only benefit. You're also going to get a tax benefit. So if you sell and reinvest, you get 0 tax savings. This is music to Craig's ears. If you use the legacy income trust, you get a $221,000 tax savings that we showed earlier. What's that potential future value? That's if over their life expectancy that we saw of 29 years, if they receive 6% income. So let's say you were able to contribute that tax savings and put it into a vehicle that was contributing 6%. You're losing $1.2 million in leftover savings that you're leaving behind. And then what's left over for the legacy, right? Let's say that you were just clipping a 5% coupon on that $809,000, and that's where you were taking your income. And the remaining leftover you wanted to give to a 501c3 charity. Well, if you're clipping the coupon and you're not raising any money in bonds, essentially that's where that total value is going to sit. With the legacy income trust, because of the equity allocation we have, not only did you get a higher income, not only were you able to get a huge tax savings that appreciated as well, you're also leaving money behind in a much more substantial way, over 2x of what you would have in that bond portfolio, to the 501c3 charity of your choice. So once again, just to wrap up, the ability to be able to get more income while you're living, a much higher tax deduction, never pay capital gains on that appreciated security, and leave a much larger legacy behind for your 501c3 is something that we're really excited about. It's something that I'm happy that Judd and Craig were able to bring on and bring to your attention.
All right. Well, Alan, I definitely appreciate it. I want everyone to know that a couple things. One, I know he showed an example of $1 million, but $1 million of appreciated stock there. But obviously, Alan, I know that you are able to do less, correct? And furthermore, I also believe you do not have to be an accredited investor. This is not an alternative. Is that correct, Alan?
Yeah, that's exactly correct. So you do not have to be an accredited investor. You're more than welcome to contribute whatever you'd like. And one of the slides there I showed earlier showed that the minimum was $20,000. So perfect. This is not something that you have to put your entire portfolio into. As I mentioned earlier, talk to Craig and Judd, and they'll give you a good highlight of what works best for you, and we're malleable in what we can work with on you as well.
Well, Alan, I appreciate it, and I'm sorry, Judd, take over.
Yeah, no, Alan, fantastic job, buddy. I really appreciate it. I know that, not everybody is wanting to leave a legacy, but for those that do and want a great tax benefit from it, as well as a lifetime income, I think this is a great option to look at. And with that low minimum, I think it's really just fantastic. You don't have to have that $500,000 or $1 million. So thanks a lot, Alan. I appreciate everything. Folks, if you got questions about that, again, we're not doing question and answers tonight, but y'all can reach out to us. Thanks, Alan. Have a great evening.
Thank you as well.
Fantastic. So the next two we're going to actually kind of bundle together in a sense, and you'll see that after we finish up. But I want to introduce Tanner Bailey with Skyway Capital Markets to talk about a very unique investment that not only can give you some huge tax benefits by putting your traditional IRA that's going to be taxed in the future into a Roth at a discounted value, but also diversifying your assets away from stocks, bonds, mutual funds, ETFs, and get into real estate. Some of the internal rates of return, because this is Fund 9 that he's going to talk about, have just been absolutely phenomenal. So you see a little bit about Tanner on the screen. I'm going to go ahead, Tanner, and turn it over to you, sir.
Excellent, Judd. Thank you so much. I'm going to share my screen, make sure everybody can see this real quick. So like Judd said, my name is Tanner Bailey. I'm a regional vice president for Skyway Capital Markets. And in a very similar sense to Alan, I also am essentially a regional representative. I go and I meet with financial advisors like Judd, educate Judd on the different types of alternative offerings that we can provide to him and his clients. And it's an awesome opportunity. I'll echo Alan's sentiment that Judd and Craig give us the opportunity to present to you all and give you some different ideas and some different solutions that you may not have thought of or even knew that were out there. Real quickly on Skyway Capital, I know you see a lot of, I know on the previous slide that Judd shared, you saw Skyway Capital, you saw Milgreen Capital. Skyway Capital, that's the firm that I work for. We are two sides of the business real quickly. We are a Tampa-based boutique investment bank. And on that side of our business, we specialize in sell-side transactions. So mom and pop, small to medium-sized businesses. We help those folks that are interested in exiting or selling those businesses. We help them go through that process. So if there are any folks on here that are business owners that in the next 5 to 10 years might be interested in taking, exiting that business or selling that business, I'd strongly encourage you to have a conversation with Judd. We actually at Skyway have an exclusive partnership with Kingswood to help him facilitate those transactions for his clients. The other side of the business is the part of the side that I'm on. That's called our wholesale distribution side. And essentially what we do is we raise capital for top of class, generally real estate oriented alternative private equity funds. And you'll hear me utilize the term fund sponsor a lot. And essentially all that means is fund managers. So what we do is we identify, like I said, top of class fund sponsors. We help them from a capital raising standpoint to fulfill their offerings. Again, these are all private placement. They are accredited investor only offerings. Our offerings tend to be illiquid investments, anywhere from a 3 to 4 year hold.
I will chime in real quick, Tanner.
Yes, sir.
These accredited for those on the webinar tonight. That means that you need to have $1 million of net worth exclusive of your primary, and or made as a single person 200,000 the last 2 years in a row, or 300,000 if you file jointly. But don't zoom out, folks, because you might know someone that is interested in this as well. Plus, I think the information we're going to give you tonight is absolutely stellar. Thanks, Tanner.
No, of course, Judd. And actually, it's a really good point, too, because even though, our offerings are for accredited investors, similar to Alan, we actually have most of our offerings have a small barrier to entry, right? It's a $25,000 minimum investment. So don't think that, just because it's for accredited investors only that, we're looking for 500 to $1 million. We will accept down to 25,000 in this specific offering. So to go back, right? So our structure at Skyway gives us the opportunity to raise money for multiple sponsors at one time, fund sponsors at one time. And what I love about that is that I don't have to talk about one sponsor, one asset class. I get to talk about 5, 6 different sponsors and asset classes at the same time. And why I'm so excited tonight that Jug gave us the opportunity to present, I get to talk to you all about my favorite sponsor that I currently am raising capital for. And that's this group called Millgreen Capital. As Jug mentioned, Millgreen Capital is currently raising money in their 9th fund. Yes, that means we've raised money for them in 8 previous funds. That total amount is just shy now of $1 billion of capital that we have raised for them. And what does Millgreen do? Millgreen specializes in developing Class A garden style multifamily complexes. And I'll talk about that in a second. They also specialize in developing single family build to rent facilities. So let's go back. Class A, all that means in layman's terms is how nice the facility is. And what Millgreen does is whether it's a build to rent facility or if it's a multifamily facility, it's going to look fairly similar to what you see in this picture here. They are highly, highly, highly amenitized facilities. Internally, you're looking at quartz countertops, stainless steel appliances, new cabinetry, hardwood floors. Externally, you're going to get all of the amenities in an asset like this. You're going to have the nice pool with the travertine layout. You'll have a dog park, a car wash area, multiple gyms, business center, everything that, you know, somebody who is in the renting market would be looking for. So let's talk about kind of the story with Millgreen. I'm going to skip ahead to this page right here. Again, higher level, Millgreen is really an interesting story. You know, our returns historically have been some of the top returns in the market. And to be transparent with everybody on this call, there is no secret sauce. There's no secret story. Our success is completely attributed to the relationships that our CEO, Greg Fox, has made in the last 30 to 35 years that he's been in the business. Greg Fox is the CEO of Millgreen. He's been the CFO of a group called Post Properties, as well as Preferred Apartment Communities. Preferred Apartment Communities was a publicly traded REIT, which was recently or last year was purchased by a group called Blackstone for just shy of $6 billion. He also ran Morgan Stanley's real estate investment arm as well. And during the time that he spent at Post Properties, Preferred Apartment Communities, and Morgan Stanley, like I said, he was able to generate very, very important and influential relationships that allowed him to create this Millgreen Capital entity where Millgreen enters into a co-investment with development companies. And in that co-investment, that investment is made in a multifamily development or a single family build to rent development. So these development companies that you see right here that are listed right here, these are folks that Greg has known for 30 to 35 plus years. What they do is they locate all of the sites, they oversee all of the project design, they do the construction, and they oversee the sale of the asset. So they essentially build a pipeline of assets that Millgreen will be able to invest in. And that's a really important part because you know, in a fast-moving real estate world right now, especially in the multifamily and single-family build-to-rent, to have the ability to be nimble and quick, and also have some developers that want some skin in the game. Remember, this is a co-investment, so we are making an investment in a development with the development company. It's a very added benefit. It's a very important factor here. One thing I do want to note that I did not mention earlier: where are we building these? And what you'll see here is, it's not a secret for anybody who's been on this call who's seen maybe some of the demographic trends in the mid-Atlantic area. I live in Tampa, and we've certainly seen it down here. Post-COVID, you saw, well, I shouldn't even say post-COVID, mid-COVID and now post-COVID, we've seen a massive influx of new residents in kind of the Southeast and what we kind of like to call these tertiary, secondary markets, right? You know, Tampa, Florida, Charlotte, North Carolina, Raleigh, North Carolina, Nashville. That's a massively growing city. Really states that A, have potentially good tax benefits, but B, they're friendlier because from a rent standpoint, and that's how we that's how an institution would evaluate a fund like ours, is the income being generated from the assets we develop. From a rent standpoint, there's a lot of rent growth in these markets, double-digit rent growth when the national average is somewhere in between 2 and 3%. So again, you're going to hear us talk a lot about the Southeast and why we like the Southeast. And it's a fairly simple story to understand. We see a lot of those demographic trends, the population growth, the wage growth, the job growth, and most importantly for our fund and the institutional buyers, the rent growth. So the offering itself is going to be a $150 million offering. There's two ways to invest in Millgreen. We have two different share classes. One is an income share class, and one is a growth share class. The income share class pays annually a 6% current income. So you would get, roughly 50 basis points. Talk about that in a second. 50 basis points on your investment back in a monthly paycheck or a monthly wire, and then you would accrue the additional 4% over the course of the fund. Again, it's in a liquid fund. So once we start selling assets, that's when you would get the remainder of that money back. You would accrue that 4% for every year you're in the fund. That's the income share class. High level, the growth share class, it's just no current income. And instead of 10%, you get 12%. So there's a slightly higher return with the growth share class. We've been doing these types of investments. Like I said, this is our 9th fund. We've made over the previous 8 funds, roughly 34 investments. Of those 34 investments, 20 have gone full cycle, meaning 20 have completed construction, we've leased up the asset, and we've sold that asset. The average returns for those are absolutely stellar. It's taken us on average roughly 34 months to build and sell those assets. We've generated roughly a 2.5x on the investment back to the fund, which all in all is about a 45% IRR. Those are project level returns. What does that equate to an investor in our fund? Investors historically have received anywhere from a 25 to a 30% IRR, depending on the share class that you enter. That's the very high level overview of Millgreen. Again, it is a development deal, but what I love about Millgreen is, transparently, I never have to apologize for them. Of the previous 8 funds that we've raised money for them for, they've delivered on every single one. They're super communicative and very transparent. One of the benefits, and this is what I know Judd wanted me to specialize on. Judd, do you want to share that piece?
Yeah.
Or do you want me? You have it? I'll stop sharing.
Yeah, I've got it up here. Let's see. Right. So, tonight, again, it's all about tax mitigation. I'm sure a lot of you have heard about Roth conversions. Well, this is very interesting because what Millgreen is going to do right off the bat is they're going to devalue your money. And don't freak out, because that's exactly what we want to happen. We want to do a Roth conversion. That is the goal. And so I'll let Tanner kind of explain. This is an example of the process. And if I need to interject or what have you, Tanner, just let me know.
Absolutely. So we'll do a very, very quick high level 101 on retirement accounts. So there's 2 types of retirement accounts. There are traditional IRAs or traditional 401ks, and Roth IRAs and Roth 401ks. There are other types of retirement accounts, but these are the most commonly held. A traditional IRA is one that is funded with pre-tax money, meaning you are taxed, the contributions you make to that account are taxed before you put them into the account. Once you want to, are taxed, I apologize. They are pre-tax contributions, meaning you put those contributions into the fund or into the account. When you want to take that money out after you've turned 59 and a half, those withdrawals are taxed at your current tax rate. A Roth account is an account that is funded with money that is already taxed, which means you can put that money that has been taxed into a Roth account, and it can grow once you've turned 59 and a half and you want to take that money out. It's already been taxed, so it can't be taxed again. A Roth conversion is a process where you would convert an account that is a traditional IRA, you would convert that into a Roth IRA. And the way that works is when you convert that account, you would pay taxes on the current present value of the account upon conversion. So let's just say you open an IRA, you have $100,000 worth of stocks and ETFs and what have you. If you wanted to convert that account, you would pay taxes on $100,000. That account is now a Roth IRA, and at that point, any growth in that Roth IRA is no longer taxable.
But Uncle
Why
Sam
it makes sense?
wants his taxes. Uncle Sam says, you just got a check, Tanner, for $100,000. And so you're going to owe approximately, depending on your tax bracket, you know, maybe anywhere from 25 plus your state, you know, you might owe 40% or $40,000. So we're going to talk a little bit about how we can discount that with Millgreen and do it over a couple of years process.
Exactly. There are specific periods of time when it makes the most sense to convert a traditional IRA into a Roth IRA. Let's just say, for the sake of the public markets, you have an IRA, a traditional IRA that has, you know, you invest and buy $100,000 of Apple stock. And in 5 years, in fantasy world, Apple stock is down 50%. So your account is now down to $50,000. It would be at this time when it would make a lot of sense to convert that account at $50,000, because you would only pay taxes on $50,000. You would not pay it on 100. You'd pay taxes on $50,000. You convert that into a Roth. Let's say Apple stock goes up 1,000% over the next 10, 15, 20 years. That growth is not taxable anymore. So your tax consequence is only the conversion, the taxes that you would pay on $50,000. So how does that relate to Millgreen? And this was the long-winded way of getting there, but essentially, when we are doing construction on the 8 to 9 assets that will be in our current Millgreen Fund 9, there are going to be 8 or 9 different assets all throughout the Southeast. Some of them are going to be multifamily. Some of them are going to be single-family build to rent. What we do, the calendar year following the close of the capital raising period, we will send to our custodians and broker-dealer partners what's called a special purpose valuation. And the way we get that special purpose valuation is Millgreen will pay a third-party appraisal company. That appraisal company will go out to every single asset that is in the fund. And like I said, there's going to be roughly 9 or 10 assets. That appraisal company goes out to all of those assets. They will look at those assets, where they are in terms of the development process. Some assets might have 1 or 2 buildings of 5 completed. Some assets might still just be dirt lots, because again, we're developing over different periods of time. We're not doing all of them at the same time. So every asset is going to be in a different stage of the development process. And what the appraisal company will do is they will generate a special purpose valuation, which is anywhere from a 30 to 40% discount on the original investment. So let's just say you invested $100,000 in an IRA, traditional IRA. That $100,000 is in the Millgreen fund. The calendar year after you invest, Millgreen will report to the broker dealers and the custodian partners that we have that the new account value is actually $65,000. Now, the thing to note is, even though this is $65,000, this is just a temporarily reduced valuation. We have not sold an asset. We have not fire sale. So there's been no fire sale. What essentially we have done is we have generated a discounted value for investors that are interested in this Roth conversion opportunity. So that opportunity, or that special purpose valuation, lasts roughly a year long. And in that time, if you invested with traditional IRA money, it is the most opportune time to convert that account into a Roth, because again, you would be paying taxes on only 65% of your original investment. And then once that new account is a Roth account, that special purpose valuation, after the year-long period is over, your account goes right back up to its original investment value. So it'd be back up to 100,000. And then because it's in a Roth, it grows tax-free. So again, a long-winded way of explaining that we have a 12-month period where there's a special purpose valuation that is a discounted valuation on your investment, where it makes a lot of sense to save some money on the tax consequence of this offering by converting your traditional IRA into a Roth IRA. Judd, do you have any, you want me to opine on anything else? Do you have questions?
Yeah, so the benefit of this for everybody attending is that, for instance, you put 100,000 in, they devalue it when it's dirt or very few buildings, and it goes to, say, you know, pie in the sky, let's say 60s, it's 40%. Now you have 2 years of which you convert. So you don't have to take that 60,000 and do it all in 1 year. You actually have 2 years to do it. So you do 30,000 1 year and 30,000 another year. We're going to wrap this up with a bow in just a moment as I introduce Fred here, but I think that's kind of all we've got. Craig, do you have any questions or comments?
Tanner, great job. The one thing I want to say for my clients, well, everyone out there, unfortunately, a lot of my clients, Judd, do not have a Roth, or if they have a Roth, there's not much money in there. And you know, I talk about playing the retirement game all the time, and you got to have the Roth to play the game in retirement to make sure I keep them in the 12% bracket or less. So I want to make sure all my clients, if you have a traditional IRA, you have no money in a Roth or have very little money, this is a perfect opportunity to move some of that IRA money you have and put into a Roth. And we're going to do it at a deduction, at a severe deduction. It's going to be a nice play. That's the main thing I just wanted to get across to my clients. Now, the one thing is, and I will put this out there, if you have money in a 401k, Judd and I may have a way to make that happen, but you just need to talk to us. That's a whole nother deal, but we may have a way to make it happen, right, Judd?
Absolutely. We're going to wrap that up with a bow here in a moment. But Tanner, thank you so much for your time. And we have actually a client or clients that have actually been in Mill Green. They will start doing their first conversions next year. And we're going to talk a moment about how to get a fantastic income tax deduction through U.S. Energy. Tanner, again, thank you so much. Have a great evening. If you want to drop out, you can. Go back to that youngin' you just had. Congratulations.
Thank you very much, Judd. I appreciate the time tonight, everyone.
All right. So I'm going to introduce Fred Gatz with U.S. Energy. Before I do that, though, you can see he is a Director of Business Development in the Atlantic region. We have been working with U.S. Energy for the last 3 years or so, and some of the distributions have just been phenomenal because of gas prices. But nevertheless, before I do that, one of the things I think that Craig has really enjoyed about working with me is that I love to put my clients into the same thing that I have. And so I sold my office building last year, as a lot of you know, and I had not only a capital gain problem, but according to what Craig told me, because I had depreciated my office, that actually comes back as income, if I'm not mistaken. Craig, am I right? You could just shake your head if you like.
That is correct.
So I had an income problem too, folks. So I did some other things. We could talk about OZs. Some of you on this call have done OZs. But as you can see here, I did $100,000 into U.S. Energy. So anyone that is interested in doing this, I'm going to be standing side by side. The difference is I'm going to be in the 2022 fund. The 2023 fund is now open. Fred, I'm going to throw it over to you, sir. And by the way, we're probably going to run a little bit late, folks. And I knew we probably would with 3 speakers tonight, but I promise it's going to be worth your while.
Awesome. Thanks, Judd. Let me grab the screen here and okay, I did it backwards. Hold on a second.
No problem. I love the fact that Alan was saying we look like we were on with the talk show host. Fred's got it going on with the microphone and everything there. So we probably will not have any sound issues, I hope.
No, we should be firing right there. Let me okay, let me pull this back over here. Now, Judd, is that coming up? I got
It is. We're not on slideshow just yet, but
Yep.
we definitely got you going on. There we go.
Okay, perfect. So yes, thank you everybody for your time. My name is Fred Gratz with US Energy. We are a privately held oil and gas investment firm, and really what everything we do kind of comes down to one thing: it's tax. And there's a lot of different ways to kind of slice that. I'm going to try to focus on one or two for our purposes here tonight, but with that said, I won't belabor all of the kind of what I say the boring stuff, right? Us, our history, but in general, we're pushing 5 decades in terms of how long we've been around, incorporated back in the mid 70s. And we are a family-owned, privately held oil and gas investment firm. We are the largest syndicator of these kinds of offerings in the energy space in the nation. At this point, we're pushing about $3 billion that we've deployed throughout all of the prolific areas within the basins and the depths of the oil patch. And we have several different styles of funds and different structures, but I'm going to really kind of focus really in on one. I'm calling right now up from Buffalo, New York, up in the Northeast here. And it's kind of a legacy headquarters for us way back when. We don't do much in the Northeast anymore. It's more natural gas heavy, even though we have over 1,000 wells there. The biggest kind of concentration that we have in terms of a footprint is going to be in the Western Texas area in the Permian Basin, and I'll talk a little bit about why. But the first thing that I'll say is in terms of just the marketplace that we're seeing in the last 5 years, we have seen so many I guess exogenous forces line up that we're really creating a massive tailwind for this space. Even if we separate the tax talk, we try to look at things, and we do look at things on an economic basis. Does this investment make sense without tax benefits, right? And if it does, and there also happens to be a tax arbitrage we can kind of lay on top of it, that's where we'll structure a fund, right? And so historically, going back 10 years, 20, 30 years back, we were doing a lot of this stuff ourselves. Taking our own acreage that we have on the balance sheet, raising capital to develop those assets and passing that cash flow on to investors and those tax benefits. That's changed quite a bit in the last few years. And so the single biggest way has actually been the operators of our assets. So we actually don't operate maybe more than 5 or 10% of any portfolio. And it sounds kind of backwards for a large oil and gas firm. But the biggest reason is that we have been able to partner with the biggest oil and gas firms out there on operating and completing their best projects. And without getting too long-winded, the reality is this: the last several years, in terms of pricing challenges to the space, in terms of the carbon is bad, or the social movements, ESG, environmental, social governance, all of these things basically. Capital has been avoiding our sector. And the reason I point that out is we have been a benefactor. Our capital base has been a benefactor of that because we've been able to partner with the biggest firms out there on their acreage, right? So when we're partnering with, say, Devon or Oxy or Shell or XTO, who drills for Exxon, we're getting their geology, their infrastructure, their acreage, their takeaway capacity, their scale. It's been a really nice environment for deploying capital. Again, not just for tax reasons, which I'll walk through, but more importantly is the economics behind them.
And I think one thing that, it's interesting is, despite what some folks up in Washington, D.C. may think, but our country has always wanted us to be energy independent. And so there is a little known tax law that Fred's going to mention called intangible drilling costs that can be absolutely amazing. And that's what we're to talk about for sure tonight.
Yeah. And I love your slide there.
You're ESG certified, right, Fred?
Well, we are. Yeah. Yeah. There's a lot of those agencies for those monikers, but absolutely. And there's a lot, which sounds kind of weird, right? How can an energy company be ESG? And it has, there's a lot of different things. It's about the controls. So it's being a good steward and following all of those EPA regulations. And this slide here reminds me of what you just had up, Judd, which was your own personal investment. And I personally am invested in several of these funds, including last year and this year. And we do the same at the corporate level, right? It's just bigger numbers. So we are the largest investor in any fund. So last year, what that meant was out of the 270 million that we raised for a structured fund, we put another 127 million into that same asset, right? So we're very much a fan of the chef eating their own cooking. And from us, it's been a no-brainer because the results have been not just great from the standpoint of cash flow, but what our investors really like is they've been predictable. And we've kind of built this portfolio on that premise. And basically, and I'll cover tax in the markets in a moment, but basically investors come to us because they want two things. They want clear, concise tax benefits, to Judd's point, but after that, they want predictability. If markets go up, they want to participate in that growth. If markets go down, they want protection, right? And so with our hedging strategies and other things that we've put to guardrail and kind of put that safety net out there to protect that downside, it's been a really nice environment for those that are looking to do tax planning. So I'm actually going to skip, not so much for time here, but I am going to skip some of the macro content. And Judd, the reason I do that is that we're actually having a macro only discussion early next week. It's going to be live. We're going to have some expert speakers from outside our firm come in just to talk about all this stuff for people that want to get really in the weeds of, okay, well, how are these sectors doing? How's oil price doing? Where's it going? Why? All of the OPEC news and the supply demand fundamentals. We've got a lot of that actually coming and so again, that'll be client facing. Judd, I'll make sure that you guys have that for those that really do want a deep dive. In a very kind of short kind of minute here, the biggest thing that we've actually loved is we really want prices to go down, which sounds kind of crazy. We want prices to go back to the high 60s to high 70s. That little bandwidth has been actually very, very profitable for our acreage positions and our investors. And it also allows for a continued kind of CapEx that makes sense, right? If prices went from 85 to 130, things get way more expensive, right? And you start to see some assets that don't make economic sense. We kind of like the best of both worlds. So we've actually been fortunate to be in that space where we would love to see prices actually come down a little bit from the mid 80s that they are from here, because it allows for this continued investment in the space. The reality, though, in next week, we'll go more into this. The reality is we're probably trekking closer to that 100 for longer, for a number of reasons, not just the geopolitical and the short-term conflicts that we're seeing, the wars, just a lot of supply demand fundamentals that are behind that. So I'll go through some of this that in terms of the actual fund structure that's a little bit more relevant than some of the other content here. But in short, I'll point out a couple of the things. The fund size is a little bit larger. It's about 300 million for this specific fund. The one thing I will call out here is the closing date. Tax law tells us we have to close December 31st. Right? That's just the tax law. I will tell you this year, it's probably closer to December 1st. It could go to the 15th, but I'm going to say probably closer to the first week of December, because we were massively oversubscribed last year. And this year, we're well ahead of last year's pace of capital. So it's all capital pace dependent. Just know we're not so much 2 months and change out, probably closer to a month and a half or so before that. And we have
so that is a call to action, folks. I know that we've had discussions with some people on this webinar tonight, and you've been thinking about it. That's great. We're not high pressure, but you just heard it straight from the horse's mouth. This is going to be available for about 45 days only, and then it's gone. So it won't be around until June, July next year, if they even have a fund. So, right. I'm sure they will, but nevertheless, sorry, Fred.
No, it's really good. You're not so much under the gun quite yet. But we also know that people don't like to feel pressured. Like, hey, here's a great concept. It saves you money on taxes. It's got killer economics. It closes tomorrow. No one wants to be in that position. So we're not there. But that day, these things tend to have this kind of flash in the pan as far as capital that's inbound. So just keep that in mind. We're, bottom of the 8th inning or so with that, but the 9th is going to come and go pretty quickly. And so let's just talk a little bit about, and I'll try to skip the boring stuff, right? What do people look for? What do these things do? How do they work? And really how are these things structured for investors? And so, and you guys heard some great content from others on the tax side and on the real estate side. We're, again, specifically in the energy space. Technically, it's all real estate. We just develop assets underneath the ground, and we produce those assets for cash flow, namely oil, 95% focused on oil. And as those assets are produced, all of our investor partners are sent those distributions on a quarterly basis. So let's kind of break that down for a moment, right? In the first year, looking at the first bullet point, investors kind of come in for that upfront deduction, right? So if we just take, let's just say $1 for easy math, you're going to get about a 90% or 90% write-off on that dollar that is going to offset your income, right? So on the CPA side, it's an above the line deduction, but really all that means is, we put this in real terms, you have an individual that makes, say, $700,000, just to make up a number, and they put 100,000 as an example in that structure, and that 100,000 as a 90% write-off, right? That's the amount that we can take as an upfront deduction. That's a $90,000 deduction. So his income of 700 before anything else just went down to 610. And so as an above the line deduction, it doesn't interfere with other tax planning. These are, for the CPAs out there, these are what are known as non-preference items. So it works within the AMT framework. And then the fun part is when you start to see cash flow, right? So and Judd, you're going to see this, I think, what's today? Either tomorrow or Friday, as the Q3 distributions go out. And the fund that you're in is going to do, I think, about 11% this quarter. And we've got about half of the assets left to come online.
So that would put me at 15% for the year, I think, Fred.
Correct. Yeah. And it's actually a little bit ahead of pace. We target within the first 18 months or so, we target investors to be, and forget tax benefits, put that on the shelf. We're looking for between 35 and 50% just straight cash on cash returns in the first, call it 18 months. So between now and June of next year, if your dollar that came in saved you, say, 30 cents as an example, you're going to have another 50 cents in cash flow. So your dollar has been de-risked down to 20 cents after the first year and a half, and you still have 20 plus years of income, if that makes sense, right? And so what investors will get is every quarter, starting in the first quarter, all that cash flow. And it starts slow, and I'll show you the numbers, but you do have some nice tax advantages to the income as well. So it's nice. You don't just have this tax benefit on the way in, you also get it on the way out. And really where that tends to, and I'll kind of just break this out a little bit, but you want to look at both sides of that, right? And I'll show you the some figures here in a second of returns without cash or without tax benefits and whatnot. But investors will first look at, well, let's look at my first dollar, right? So you're going to save, and it's going to depend, right, on your brackets, where you're at. But whatever's the highest tax bracket you're in is what this will chew up, right? So if you are in that 37 plus any SALT tax, right, state and local tax, that could be 35 to sometimes 45, 50 cents on the dollar. You're going to save day one. In tax, you're not paying, because what happens is these things, as an above the line deduction, right? If you're making $1 million a year and someone put a couple $100,000 into this or whatever, that takes your million down to 800,000, right? So the rates you're getting at between 800 and $1 million are 37 federal, right? And any SALT tax. So these do a really good job of eating away your highest tax dollars first. And the way, right? And these are all of this, looking at the kind of the left-hand side of the screen here. We have multiple share classes, and I can walk through these, but these are really those trigger points for those that have, say, a higher income or liquidity event, anything that causes tax, right? The left side of the screen is basically tax paying. It doesn't matter how you get there, but those are the things that typically trigger some kind of a heavy tax burden. So with that, right, and we have different share classes for different reasons. We're focusing more on the upfront deduction side on the left side of the screen here, but we also try to break this out in terms of looking at the economics separate, right? So again, as far as tax benefits on the way in, you're getting a 90% deduction on that dollar, on every dollar that comes in. And then you're also getting some tax advantages on the way out. There's depletion allowances, there's some 199A deductions on the tangibles. I've got a little workbook that has all the tax stuff outlined. But outside of that, you're also seeing cash flow, right? And the pace of that cash flow tends to be very heavy, very quick. And so, and you're looking at, and Judd, this is the number that we were talking about before, right? Yeah. So after this week, you'll see this figure for your 2022 fund. And then you can kind of see, looking back, how things have done historically. We're looking for the 3 or 4 year window to get your first dollar back. So just cash on cash, forget taxes, dollar in, dollar out in about 3 to 4 years via the cash flow, plus in addition to the tax benefits, and obviously still cash flow. These wells can cash flow for 20 years, right? But really you're getting a lot of that early on. So what I like to say is these are, and I've got some other economics to show more regional basis, right? Permian basis focused on asset levels, how these assets are doing. But really it's there to get someone a lower tax bill and then recoup their investment as fast as possible. And that's really kind of a look at both. So the deduction on the way in, very fast, very heavy cash flows on the way out with some tax benefits on the income itself. And then here you can see, just another slide on the economics, cash on cash return profiles, those with and without tax benefits. But just understand just the nature of how these things go and how they produce. They're by design going to return very heavy cash flow. And that's the whole point, right? And especially, right, looking at how do the next, say, 3, 4, 5+ years of the broader markets look, right? There's some big question marks there. And that's not the purpose of this discussion, but my point is, if we're a little bit concerned about the short and medium term health of the equity markets, having something that throws off massive amounts of liquidity and cash flow back in your portfolio, right, is never a bad thing, right? It's a great little cash tool to have in the box that's putting that liquidity back in. Because if you see a downturn in the market, or there's some other opportunity you want to capitalize on, this can be a great cash flow machine to keep that cash reserve full, to take advantage of those opportunities and have that dry powder when it makes sense.
Make money while you sleep, brother.
That, what, your Warren Buffett quote, kind of made me think about that, but this is it, right? You want to wake up and have a check, and that's what's cool. This stuff is all part of the tax code. We actually, and I have it here, and I don't know if I sent it to you the most recently one, Judd, but we have this little tax workbook. This has all the tax code. We get this all the time. Well, I don't think that works, or those are passive deductions. No, this is not a private letter ruling. It's a tax law in a book. That's all it is. And we've outlined all that just to make it clean. The other thing that I'll say, and just to kind of wrap this and keep it kind of short and sweet, is more than anything, yes, we look at thousands of deals in all of this stuff every year. But the biggest thing that we are, and this is one of the slides that help, I think, showcase that, is we're just a big data company. That's really all we are. We only do, and we look at these areas. This is a Permian asset with Occidental that we did. We look at areas. We don't do exploratory or unknown reserves. We don't do offshore. This is middle of the fairway stuff. And all these little lines that you're seeing, right? So this blue asset is this $100 million package that we picked up earlier this year for this fund. But all of these neighboring assets, these little pencil lines, these are all 2 and 3 mile horizontals, right? So each one of these wells are $9 to $12 million, right? And you're just seeing a lot there. But the reason we do that is it just adds that predictability, right? When we're going in, we're looking at data sets from the assets east and south and north and west of where we're drilling. And it's that predictability that our capital base comes back to us for every year, right? Now they're not looking for massive 10, 20 to 1 return profiles. They know there's not enough risk in what we do to get there. But at the same time, right? At the same time, if they can come in and have predictability and have participation on a market that's growing and going up, and have protection when markets are going down, because our hedges can activate if prices collapse and get them their money back. Those are the constructs that investors tend to look for, right? And
Greg, did you have a question?
I just,
Or
well,
comment?
he's moved off the taxes, but Fred, first of all, I want to tell you that I'm very impressed with U.S. Energy. I've been dealing with y'all now for over 3 years, 4 years.
I think so, yeah.
And I can tell you, and this is from experience from the tax side, because I do the tax returns and I see them. I just pulled someone's tax return up that I know is in U.S. Energy. And this particular person put in $100,000. Day one, he saved $38,640 in taxes. Let's just call it 39 grand. I know you keep on talking about the cash flow, and it's been wonderful. But the way I look at it was he was going to pay the Fed and state $39,000. I said, you want to pay them $39,000, or you can pay U.S. Energy $100,000, and the government subsidizing. So basically, he only gave up 61 grand. Since that's all it cost him, was 61,000. Since then, the man's already got over 35,000 back. Yeah, he's gonna be flush with that. So you take the 39, you take the 35. We're calculating that he's going to be flush sometime in 2024. It may be the end, but he's going to be flush.
Yeah, and he's still got,
and now he's got another 10 years, maybe 10 to 15 years, where it's just paying him money.
And
so
that's it. And that's exactly what
I've been very impressed with it.
Yeah, and that's the whole point, right? And again, that's kind of what our DNA is. We don't want to find the next basin. We don't want to, we're not Cheniere or Pioneer. We don't want to develop the next technology. That's somebody else's game, right? But when you're just going in and trying to find, and really at the end of the day, all we're doing, right? And this is a 100 million package. Here's 24 million. Here's another 30 million. All we're doing is developing a bell curve of predictable return profiles from 100 to 120 wells in one single fund, a diversified portfolio that really you don't see things get out of that first standard deviation. And there's an upside and a downside to it, right? We lost a big case about 2 weeks ago because as a huge investor, there wasn't enough risk for him. He wanted to know that, hey, if things went amazing and the well hit, right, and all those kind of, he was going to get a 15-to-1 return. That's like, call somebody else. Our capital base doesn't want that, right? They want predictability. The markets go up, participation, markets go down, protection, and the markets stay flat. They want to persevere, right? The 3 Ps, and that's really how we've built this out and designed, and it's why we work with the majors. They allow us to hedge our production. It's why we go into the core of the Permian, where normally we don't have access to this stuff, right? We've been looking at and trying to get involved in all of these assets for years, and it makes no sense. We should not have continued access to Chevron's best acreage, to Exxon's best projects. It really should not exist. But what we've seen is this decoupling. Normally in the investment world, we're talking about risk and return and how they're tethered together and it's unbreakable. That's kind of decoupled in our space, where you're getting returns that are a little bit outside the scope of your risk. And so for that reason, that's why our funds keep getting bigger. As long as we have this inventory, we're going to do it. And that's why we don't drill our own. I've been here 10 years. We were operating all of our own assets for years. We didn't do any joint ventures, right? And over the last few years, about 5 years ago, it was about 50-50. Today, it's 95-5. Why? Because when we get back to these guys that run all of our models. Sorry, I'm being choppy here. Their stuff is literally just that much better than ours. If we're going to be able to get that access and get payouts, so we have some assets that are cash flowing their cost within 18 months. Wow. At an asset level, right? And investors getting all their money back within 3 years and all these great tax benefits. As long as we still have that, we're going to do it. As long as we can hedge, right? That's the biggest thing. We want to take out and strip out as much downside risk as we can.
Fred, unless we've got some other notable things that you would like to show other than your notable partners, which is fantastic. I want to kind of wrap this up with a bow because we're definitely getting beyond our time, and I certainly want to keep on that.
Sure. Yeah. So here's I'll kind of take the off ramp then. So here's our public site, usedc.com. You'll find online calculators here. You'll find other resources such as that's the tax handbook I mentioned, and videos, white papers, all kinds of stuff. But we just wanted to kind of, showcase some of the things what you're seeing, what to expect and whatnot. But I think that would be the, kind of the gist of it in terms of the tax place.
Awesome job, Fred. Craig and I are extremely pleased, both from a tax perspective, from an income perspective. And when we process an account, y'all have been fantastic. If I've had to call up Fred or Garrett or Nick to get them on the phone with a client, they are there for me. I've actually got their cell phones. I probably drive them crazy, but nevertheless, I do have it. They allow me to have it, just like my clients have my cell phone.
Yeah.
So
exactly.
to wrap this up in a bow, so to speak, I want to say that we talked about mill green. So let's say that someone takes 100,000, they devalue it to 60,000. And then they do a Roth conversion of 30,000. They do it over 2 different years. So what Craig and I came up with is just absolutely genius. So if you want to mitigate all of that $30,000 worth of income, what you do is make about a $32,000, $33,000 investment, because we're going to get more than likely a 92% tax deduction and into U.S. Energy. And bam, we have just washed that income away. Greg, would you agree?
Yes, if you take Mill Green and you take the U.S. Energy and you do both products, we can wipe out the tax, and you can own U.S. Energy, and you can start moving your IRA, traditional IRA money to a Roth. I think it's a no-brainer. It's a no-brainer at this point.
Fred, you can take your screen off. I'm sure if mine's already showing. But so again, a good speaker, I think, kind of repeats what we did, tied up in a bow. We talked about tax mitigation. We talk about diversifying into asset classes that most of us have not been able to access in the past. That's real estate. That is oil and gas. We talked about creating a fantastic income stream, whether it's doing a legacy income trust and leaving a legacy to some of the charities that you would like to be benefactor of, have a lifetime income stream like my father and stepmother still does to this day, and get money into a tax-free for life situation, but do it at a discounted valuation. So I think that's kind of tying it up in a bow. We really appreciate your business and above all the trust that you've put into us. Craig and I think you talked, a couple of people have talked about it, but it is rare, surprisingly enough, that a financial advisor and a CPA would work together as closely as we do. So for those of you that are working together with us both, we really appreciate that. Craig, anything you'd like to wrap up with?
Yeah, if there's any questions, please contact myself or Judd. Because we presented a lot tonight, and this is some exciting stuff. And the thing is, like, especially with U.S. Energy, I have a lot of experience with it. So I know exactly how it will work on your tax return. The Mill Green is new to me. I know they've been around, but it's new to me. I love the concept. The main thing is, you have a question, we just hit the highlights tonight. If you have a question about your situation, because everyone's different, just give us a call. That's the main thing for these webinars. So if you find something that you're interested in, we don't expect someone to make a decision based off some slides. Give us a call and let's put numbers to it. Absolutely. It all gets real when we put it down into your software. That's for sure, Craig. So thank everyone for attending, whether you're an MTS client or a JHG. Thank you, Fred. Wonderful job. Everybody had a great evening. Talk to you soon.
Guys. Thank you.
Bye-bye.